When we talk about high interest rates and their effects on the economy, we usually talk about it from two places: the effect on consumers and the effect on mega corporations and their ability to borrow and continue to grow. But what about the little guy, the small business owner, the man or woman brave enough to take the entrepreneurial road without the backing of major investors? More than 50% of all jobs are created by small businesses, which means not only is the business owner affected by interest rate changes, but so are more than half of the country's employees. So today, we're going to go over Robert's story, a fence and gate installer with 10 employees, who from 2015 to 2020 made enough to pay his employees well and to make a living. Unfortunately, from 2020 until now, things went to bad and have crept into worse. So, let's tell Robert's finance story. Robert started his business in 2015 with one goal in mind: make a full-time income for himself while at the same time paying his employees a great wage. He created this business after spending 10 years working for another gate and fence installer. And for the first 5 years, his business grew. First, it was just himself and 1 or 2 jobs per month. Then it was him and 1 employee, and then 2, and then 3. And eventually it got to a point where he felt so confident with his job sheet to bring on 2 more employees and to do the metalwork, if required, himself in-house. So he leased a 2,000 square foot workshop close to downtown and expanded rapidly to 10 full-time employees. And from 2015 until 2020, things went very well. Did he become a millionaire? No. Did he continue after that point to expand rapidly? No. But for 5 years, he was able to accomplish his goal: make a full-time income and pay his 10 employees well. And then, as with many things in the current economy, 2020 happened. The economy was basically shut down, at a standstill. Non-essential work was severely limited. And not only that, but people became extremely cautious about letting strangers into their homes. And on top of that, distancing mandates made work at Robert's shop extremely difficult. All in all, 2020 was the first year in his business's history that a year-over-year decline in the number of jobs and revenue happened. And it wasn't small. It was a massive decline. About 60% less jobs than the prior year. Barely enough to cover rent, expenses, and most of all, payroll. But Robert was committed to paying his employees a fair wage. So instead of cutting workers or cutting hours during a time where he knew people needed it, he chose to take a pay cut himself instead. After all business expenses, rent, utilities, and payroll, Robert barely took home a few $1,000s in 2020. "I almost closed down the business," he said. "There didn't seem to be an end in sight to this mess. And I knew I couldn't go basically another year without paying myself." Now, luckily for Robert, 2021 was a little better. Robert made use of the Paycheck Protection Program, which he did fully pay back in 2022. And after being in this mess for an entire year, Robert started to look and found as many areas as possible that he could cost cut. Again, without cutting employees or pay. Now, business was still down in 2021 when compared to 2019, but it was better than 2020. Total sales were about 67% of what they were in 2019. And with the cost cutting, payment protection program, and better sales, Robert was able to take home about $37,000 for the year. The future was looking brighter, and Robert had higher hopes for next year. And then 2022, next year happened, and Robert was thrown right back into the frying pan. Robert says that 2022 started off well, and they had high hopes after a better 2021. But as the months progressed, it was clear that was not the case. Month after month, sales in 2022 slid downward. And on top of this, Robert noticed that his workshop's rent increased more than usual. He also noticed that his business credit card interest rates went up, and he noticed an increase in his variable rate revolving line of credit, which his business relied upon heavily to make purchases for parts, materials, and equipment for gate and fence installations. And the trend unfortunately continued for the entirety of 2022. His rates on everything credit-based went up, and his sales continued to slide down. And one of the biggest reasons for that decline in sales was, again, interest rates. Consumers in 2022 had some of the lowest economic confidence in recent history, which means they were less likely to spend money on non-essential purchases. Add in on top of that continuously increasing interest rates for all of 2022, and it made those non-essential purchases, especially large ones like fences and gates, more expensive to finance. So higher expenses and rent, and higher interest rates on his lines of credit, plus lower demand due to lower consumer confidence. Talk about a potential recession. And more expensive financing means 2022 for Robert was almost as bad as 2021. He took home for himself just a little over $37,000, which for a family of 3 consisting of himself, his wife, and his 5-year-old child was simply not enough. As 2023 began, Robert knew that 2 of his 3 work trucks were in dire need of replacing. But he had put off that expense after experiencing not great revenue in 2022 and 2021, and honestly, even worse revenue in 2020. But in 2023, it was impossible to put off those purchases any longer. His work trucks were basically falling apart, and they were starting to cost him money on a regular basis for repairs. Unfortunately for Robert and millions of other shoppers, 2023 was probably one of the worst times in recent history to buy a car. And he was absolutely sticker shocked when he started to shop around for replacements. Car prices, both new and used, were insane. And when he used an auto loan calculator online, he saw that the only thing that was more insane than car prices were auto loan rates. Auto loan interest rates in 2023 started out at around 6% in January and ended the year at 7.5%, slowly increasing every single month. And for context, that's almost double what auto loan rates were pre-2020. Robert tried and tried and tried to put off purchasing, but eventually he just couldn't any longer. He had to buy 2 work trucks in July of 2023, or he'd risk not having vehicles to get supplies and himself to installs. He bought 1 brand new and 1 used with about 22,000 miles on it, both F-150s. And while he saved money on the used one's sales price, he spent money on the higher interest rate. And because his costs and revenues were so close for the business, he's been paying the auto loans with money that's supposed to be for his end of the year take-home pay, which means for 2023, he took home less than $34K. And he quite simply says that this year, in 2024, with higher costs across the board, on top of the extremely high interest rates, more and more of his business costs are coming out of his take-home pay, which means that if the business does not improve by the end of this year, he says he'll be forced to do one of 2 things that he absolutely does not want to do: lay off employees or cut their pay. And if things don't improve by 2025, realistically, his entire business is in jeopardy of coming to an end.